Good evening, my dear students. How are you all? Good evening. Good evening to all of you, all my CA Inter students, all my future chartered accountants. I hope you guys are doing good. How are your preparations going on? Everything perfect? Or you're trying to do perfect things, right? Okay, so in our past sessions, almost it's been like 4 sessions, right? So we have completed initially with the introduction to the subject. Then we had what are the scope and objectives of the financial management subject. Then what are the various sources from where we can get the funds. Then we had also started and also completed the chapter of ratio analysis. Okay. So if you have any such doubts in the previous topics, you can definitely ask me in the revisionary lectures that we are getting scheduled. And I think FM revisionary sessions are starting from probably next week. Yeah, next week, Tuesday. From next week, Tuesday onwards, we have our FM revisionary sessions. So there you can come up with any of the doubts that you have in ratio analysis and the sources of finance. So chapter wise, we have got revisionary sessions. So you can definitely ask your doubts in those classes. Right now, in our today's session, we will be getting started with an important topic, which will be a foundation stone for the subsequent chapter, right? Uh, so for this chapter is going to be a basic, or it's going to be a base for all the subsequent chapters that we are going to have. So it's really important and also an interesting topic to learn with. Answers to the ratio analysis will be definitely be getting uploaded once the revisionary sessions are over. So till that time, I would require you all to solve the questions and be ready. Okay. I would require you all to, solve all the questions of ratio analysis and then come up with the doubts or solve, questions that you may have, right? So if you are done, well and good. Just have patience for maybe couple of days, couple or 2 or 3 days, right? Then we will definitely be uploading the solution and we'll be discussing those questions in our revisionary sessions also. Okay, guys. So, yeah, you have doubt in fourth question, definitely keep. We will be discussing the questions in our revisionary sessions also, the questions which I've shared with you. Right now, let's get started with the topic of cost of capital. You guys remember my first session? You guys remember my first session? That was Introduction to Finance Manager, introduction to the subject. Can you tell me what is the role of a finance manager? What's the role of a finance manager? What is the role of a finance manager? Yeah. What is the role of a finance manager, guys? Yeah, I'm waiting for your answers, guys. Come on, tell me. What's the role of finance manager? To maximize that's the objective. Maximize the shareholders' wealth is, maximize the objective. That's the objective. Now, to maximize the shareholders' wealth, what primarily two activities a finance manager is supposed to be doing? What were those two activities? What were those two activities? Getting the funds and, can I say, investing those funds, right? Procurement of funds and utilization of funds were the primary two activities which the finance manager is supposed to be doing. Am I right, guys? Correct. So when we're looking at a business entity as such, okay, when we're looking at a business entity, it is, as a business entity, what role does it really have? What is the function that a typical business entity do, right? What's the function that a business entity do? What's the role of a business entity? You know what? This business entity is basically just an agent, through which funds are going to be raised and the funds are going to be invested. So business entity is going to get funds from multiple sources, or it is going to procure funds from multiple sources. Can you tell me few sources from where the business entity can get the funds? Tell me few prominent sources from which you can get the funds. Yeah. Shares, debentures, bank loan, preference shares, equity shares, international fund. Okay, Pranav, yes, your messages are getting delivered. Bank loan, okay. GDR, ADR, okay. Equity shares, okay. So you have the sources of funds available. So as a business entity, you have multiple sources of funds coming to you, right? So you may have the shares by way of, you may have the funds invested into your business by way of equity, maybe by way of preference shares, maybe by way of debt, right? There are Anirudh, there are two CA Jagbandhu. Okay. So if there are two CA Jagbandhu, the one without the photo you can share. I mean, you can see the mic movement, right? Send your message to that person only. Because the other person is just sharing the screen. He's not listening to you. Got it, Anirudh? Okay. So you can just send a message to the person, right? Without the photo. Yes, Omkar, I can see your text. Okay. Anyway, so equity shares, preference shares, debt, these are the few sources that you can say. Or I can say there are, other sources also. Yes, I am the real one, Omkar. The real JB. Okay. So the real JB is me. You can interact with me. The other guy is just an artificial intelligence person. Okay. The only task that the other person is doing is to just impersonating my uh, face, and he's just sharing the screen and nothing else. Okay. So, yeah. So, equity shares, or you can get, funds for your business by way of reserves, or by way of preference shares, or by way of debt. These are the sources from where a business entity can get the funds raised. Now, once the funds are raised, what is the other activity which the business entity is going to do? The business entity is essentially going to invest it. Now, where is it really going to invest? Where is it really going to invest? Yeah. Wait, let me just change my name. Otherwise, you guys are just getting confused. Okay, fine. That's it. Now, no confusion at all. Okay, now, yeah, so business entity is going to utilize those funds to invest into multiple projects, right? So it's going to utilize the funds to invest into multiple projects. Now, projects can be your product line, or maybe just, launching a new product, right? Or maybe coming up with, new area of service. So any business entity, it can raise funds from multiple sources and it is going to invest in, projects. So investing in the projects, it can be like project one, then you invest in project number two, then you invest in project three, then one more investment, maybe project four. Okay, so you're investing into multiple projects. Now, it is quite obvious from these projects, what are we going to earn? From these projects, from the various multiple projects, be it a real estate, be it a new factory establishment, be it a new launch of a product, can you say we are going to get some rate of return? We're going to get some rate of return, correct? Yes or no? We're going to get some rate of return from these projects, correct, guys? Yeah. Correct. So we are going to get some rate of return from these projects. Now, suppose the company is having in its consideration a new project. Company is discussing with its management. Company is discussing with the management some new project. And that new project is promising us a return of, let's say, 12%. Promising us a return of, like, this project is giving me a return of, is likely to give me a return of 12%. Okay. So when this project is likely to give you a return of 12%, tell me, are you going to accept this project or reject the project? Are you going to accept this project or no? Yep. Are you going to accept the project or no? This is the project that we are looking into consideration. It is like whatever you are going to invest in this project, you are going to get 12% on that. So let's say that project cost is 10 crores. On investment of 10 crores, you're going to get a return of 12%. The project is going to give me a return of 12%. Should I accept the project or not? Can I say, sir, just by looking at project return of 12%, we cannot determine whether to invest or not? Am I right? Just by looking at 12%, can you say I should invest it or not? No, we cannot. We cannot decide whether we should be investing or not, whether we should be putting money into this project or not, because I need to know how this project is going to be funded. How is this project going to be funded? Can I say a combination of all this capital or all these funds, right? Some portion will bring it from equity, some portion will bring it from our resource, from reserves, some money coming from the preference shares, some money coming from the debentures, right? So it's a combination of all this, it's a combination of all these funds that goes into the project. So if this project is going to give me a return of 12%, can you tell me what should be the cost of the funds that I am bringing to this business? What should be the cost of cost of the funds that I'm raising for the funds? Tell me, guys, what should be the cost of the money that we are bringing in for the investment into the new project? Like a simple understanding, we have a project. Which is likely to provide us a return of 12%. And we are having capital from multiple sources. Now, of course, the cost of the capital should be, can I say, less than 12%, less than or equal to at least 12%? Am I right? Am I right, guys? Achha, do you remember something, the explanation that I gave you regarding the discussion when we were doing the capital gearing? Regarding the gearing part, the relation between the return on capital employed and cost of debt. I mean, return on capital employed and the interest rate. So what was our objective? If you are raising debt, you should be investing in the project which is providing you return more than the rate of interest. Am I correct, guys? So similar fundamentals is going to be applied over here. I am going to invest in a project that's going to give me 12% return. And of course, the cost of capital, right? The cost of capital needs to be taken into account, whether my cost of capital is, at least 12, cost of capital should be less than 12%. Because if the cost of capital is more than 12%, what will be the resultant impact? If your cost of capital is, let's say, 15%, and you're investing in project which is giving you a return of 12%, what will be the resultant impact of that? If you're going to raise money or raise capital at 12% and you're going to invest it at 12, less than, I can say, cost of capital is, let's say, 15, and the return that you're getting from the project is suppose 12%. What will be the resultant impact? Tell me, will the shareholders' wealth increase or decrease? Is the shareholders' wealth going to increase or decrease? The shareholders' wealth will decrease. Shareholders' wealth will decrease, right? Remember this relation, return on capital employed, if it is greater than rate of interest, only then, doing business with borrowed money is beneficial. So same way, when we are talking of a business entity, when we are raising capital, the cost of capital should be definitely less than 12%. So the point is, we need to know the techniques of both. We need to know the techniques of both. Which technique you are talking, sir? Sir, we need to know how to calculate the return that you're going to get on a project. Right? I just said it out of nowhere, 12%, right? Don't you think we should know the technique how to measure the return of a project? Yes, don't you know? Don't you think that we should know, sir, how did you get this 12%? What is the basis? What is the method? What is the procedure to get this 12% return? We should have that technique, or we should know the method using which we are calculating the rate of return. Correct? So one thing is that we should know how to calculate the rate of return using the project, right? So can I say we should know the method or technique or procedure to calculate. You should know the method, technique, or procedure to calculate rate of return of project initially. We should know how to calculate the rate of return that you are getting from a project, right? By the way, this is what you are going to learn, calculating the rate of return from the project. That's what you're going to learn from the chapter called as investment decisions. So you should be knowing, or you should be learning the method to calculate the rate of return from a project from the chapter called as investment decision. So one more thing is, sir, we should know what is the cost of capital also, right? Because we should be essentially knowing what is the rate at which we have raised the funds, right? So this, to know the cost of capital, is what we are going to look in our current discussion about the chapter. So we, like, our objective being a finance manager. What is the objective of finance manager? Tell me. What is the objective of finance manager? To maximize the shareholders' wealth, right? Objective of finance manager is maximize the shareholders' wealth. Correct? Now, to maximize the shareholders' wealth, what should the finance manager do? The finance manager should essentially invest in those projects which are giving return more than the cost of capital. So for that, we need to know two things. One is, what is the rate of return on each of the project? We should know the technique to measure that, and also we should know how to calculate the cost at which the funds are raised, or the cost of capital. And that is what we are going to discuss in this chapter. Are we able to build a background for the chapter, everyone? Is the background for the chapter very clear? Why are we doing this cost of capital? Yes? Okay. Now, the agenda for this cost of capital chapter. First, we will be calculating something called as, you can say, summary or roadmap, we call it as roadmap for the chapter. Roadmap for the chapter. The first is we have to compute, calculate cost of debt. Okay. Now again, in cost of debt, we are going to calculate it using multiple methods. Then the cost of debt, we are going to have the calculation based on approximate method, or we call it as the other method is YTM or IRR method, right? And also we are going to learn something called as bond amortization. Okay, these three things is what we have in the cost of debt. Second thing that we are going to calculate is calculate cost of preference shares. Third is calculate cost of equity. Next agenda is to calculate cost of reserves. Then finally, we are going to calculate weighted average cost of capital. We're going to calculate weighted average cost of capital. These are the 5 things that we are going to look at in this particular chapter. Okay. Now, let's get into the chapter with the first part, which is calculation of cost of debt using approximate method. Okay, by the way, all these numbers, that is cost of debt, cost of equity, cost of preference share, right, or cost of reserves or weighted average cost of capital, all of them are going to be always measured in what units, guys? Any guess? What will be the unit that will be used to measure this cost? Because whenever we are calculating anything, it has to be a measure, right? It has to be in terms of anything like kilos, milligrams, or centigrade, or it can be degree Celsius, whatever. So same way, this cost of capital, be it cost of debt, equity, preference, whatever it is, what will be the unit for the measurement? Yeah, unit for the measurement. It's going to be always percentage per annum, guys. Do take a note of it. It's always going to be percentage per annum. Okay, this is always going to be percentage per annum. Okay, because just percentage is not going to work for us. It's not going to be just percentage. It cannot be just percentage, because percentage has to be defined. It is percent, that is for every rupees 100. But then for every rupees 100, time also matters, right? Can I say time also matters, right? So percentage per annum. All the numbers are going to be always cost in terms of percentage per annum. Okay. Okay. Now let's get started with cost of debt. So obviously answer of our cost of debt is also going to be what? It's going to be expressed in percentage per annum. Correct, everyone? Yeah. Percentage per annum. Now, cost of debt using approximate method. Now, let me just take an example to help you understand this concept in a more better way. Okay. So suppose when you're looking for cost of debt, let's say there is a debenture. Okay. There's a debenture with certain characteristics. So debenture has got a face value of suppose 1,000. 1,000 is the face value. Okay. The debenture can be issued in the market. The debenture can be issued in the market, let's say at a price of 980, right? So we are going to issue this at a discount of, let's say, 2%. So we can issue it, let's say, in the debenture in the market at a price of 980. We can issue the debentures at a price of 980. Then we say there's a redemption applicable. The debenture can be redeemed, or debenture is going to be redeemed, let's say, at a premium of 5%. Debenture can be redeemed at a premium of 5%. So what will be the redemption value? What will be the redemption value if the debenture can be redeemed at a premium of 5%? Premium of 5%, 1050 is the redemption value. Okay. Term of the debenture is suppose 5 years. Term of the debenture is, let's say, 5 years. Okay. The face value is 1,000, issue price is 980, the redemption value is 1050, and the term of the debenture is suppose 5 years. Okay. Now, face value we have 1,000 for redemption. All these are clear. One more important term is coupon. Now, coupon is basically the interest, I can say interest on interest or the coupon rate. Okay, interest or the coupon rate is suppose 10%. So if it is 10%, of course 10% per annum, but then 10% per annum translates to what amount of interest or coupon, guys? What is the amount of interest or coupon that the bond is going to pay to us? It's going to be 10% of face value always. So this is going to be 100. Right? So that's going to be 100 definitely. So interest or coupon is 10% per annum, which is 100. Okay, is it clear, guys? Now, so these terms are definitely in rupee terms. Okay, and even the coupon amount is in rupee terms. Okay, so face value is 1,000, issue price is 980, redemption is 1050, interest or coupon is 10% or rupees 100. Okay, so now based on this, we have to calculate something called as cost of capital. But before that, let me give you one more information, something called as flotation cost. Flotation cost is, let's say, 5%. Flotation cost is 5%. Do you know what is a flotation cost? Do you know what's the flotation cost? No. Flotation cost is basically when you are going to issue debentures for the first time. When you are going to issue debentures, or for that case, any security, be it debentures, be it equity shares, be it preferential, whenever you are going to issue it for the first time, you are going to face certain charges. Like you need to pay some fees to the SEBI. You will have to pay some commission to your underwriter. You'll have to bear some expenses regarding printing of the document, some brokerages, some expenses, some charges which you are going to pay. The legal fee, the technical fees, the contractual fees, the expert opinion fees, or any sort of expenses that is required to be paid for raising the money, all of them are going to be called as a flotation cost. Okay. Is the flotation cost clear, everyone? Yes. Okay. So if the flotation cost is 5%, can you tell me what will be the amount of the flotation cost? Can you tell me what is the amount of the flotation cost? Yeah. Amount of the flotation cost will be 5% of what? It's going to be 5% of the issue price. It's going to be 5% of the price at which the bond is issued. right? Because see, you are incurring this flotation cost to get rupees 980 today, right? Am I right, guys? You are paying this 5% to get rupees 980 today. So obviously it has to be a percentage of that 980. 1,000 rupees is the face value on which you will get a dividend. You will get the interest or coupon at the rate of 10%. So flotation cost is 49. Okay. Now, if I ask you, what is the net amount that you will receive today? What is the net amount that you will receive today by issue of these debentures? What is the net amount that you will receive on issue of this debenture? Can I say it's going to be 980 minus flotation cost? So this is going to be 5% of issue price. And then net proceeds is going to be 931, which is simply 980 minus 49. Okay, guys, net proceeds of 931. Got it? Okay. Why flotation cost is charged to issue price? Because it's going to be a percentage of issue price. Whatever is the price that you're going to get for each of the debenture that you're going to sell, it will be a percentage of that. So it is like cost of getting the funds. So how much amount you are getting, it's going to be a percentage of that, correct? Got it? Okay. So now my question to you is, let me see how many of you can really think of it and answer. Forget that percentage part. We want to compute the cost of debt. Forget that percentage part. How to compute that percentage, that's a separate discussion. We'll take it up. But if I ask you, what is the cost that I am actually bearing? What is the cost that I'm actually bearing for these debentures on a per annum basis? What is the per annum cost of debenture in rupee terms? Can you calculate and tell me? What is the per annum cost of debentures? What is the per annum cost of debentures? How much is the per annum cost of debenture? How much the cost that I'm bearing for every unit of debenture? Per annum. Every year, what is the cost that I'm bearing? You know what? This cost actually comprises of two parts. One is definitely the interest that the company is going to pay, plus additionally, you just think of it. What is the amount that you're receiving today? What is the amount that you're receiving today? 931. How much is the amount you're going to pay back after 5 years? What is the amount you're going to pay back after 5 years? 1050. Correct? So you're receiving 931 today. You're going to pay back 1050 later. Then tell me, if you're going to receive 1050, sorry, you're going to receive 931 today, you're going to pay back 1050 later. Then tell me, what is the total cost that you're bearing? What is the total cost? The difference is there, right? 1050 minus 931. 119. Is it 119 or 169? We look at the difference between this 1050 and 931. It's 119, right? So we are, paying 119 more than what we received. We are paying 119 more. Can I say we are paying 119 more than what we have received, correct? Because we received 931, but when it comes to repayment, we are repaying 1050. Am I right, guys? Are we getting this concept? This is 119, which is extra that we are going to pay in future. Now, don't you think this is also a cost for us? Don't you think that this is also a cost for us? Yes. But then is this cost for 1 year? Is this a cost for 1 year? Or is it a cost for the entire tenure of the bond? It's a cost for entire tenure of the bond, right? So can I take this 119 difference as, added to the interest per annum. Yeah. Yes. So can I say the difference, can I take it as spread over a period of 5 years? Right. So 119 over here, this is the difference, or this is the extra money that we're going to pay. This is the cost. And this is definitely a cost, but this is a cost for full 5 years. So we have to, can I say, spread it over a period of 5 years? So what will be the per annum cost of this 119? What will be the per annum cost of this 119? Can I say 119 divided by 5? Or I can say per annum cost of debenture is obviously interest that we are paying per annum. Also, plus, can I say redemption value? Is like redemption value minus the net proceeds divided by number of years. Yes or no, guys? Can I say that per annum cost of debenture can be computed like this? Interest per annum plus redemption value minus net proceeds by n, or I can simply say in short form, this is interest plus RV minus NP by 2. And if I just go ahead with the calculation, so it is 100 plus redemption value is 1050 minus 931 divided by 5. Sorry, it's going to be divided by 5 or number of years here. Okay. Then this is going to be 100 plus 1050 minus 931 by 5. So this is 123.8. Can I say this is percentage per, sorry, not percentage, per annum cost of debentures? It's 123.8. Correct, guys? Can I say it's 123.8? Yes. Okay. Now, yes, B, Sai Kiran.
So this redemption amount 1050 and flotation amount is for first year. Flotation for first year and redemption amount for 5th year. It is not for all the years. Na?
Redemption amount is what you have to pay back.
And that is 5th year, sir.
5th year, correct, yes.
Not every year, na 50 rupees.
No, not every year. This is going to be paid in 5th year, but you have received the money how much? After flotation cost, you're receiving 931.
Yes.
Yeah, you received 931 and you are going to pay 1050. So additionally, you're going to pay 119 than what you have borrowed.
That 50 rupees we have to take for 5th 1 year only, na? That I'm telling, sir.
No. The moment you have issued the debenture, there is an obligation on you to pay this 50 rupees additional. And that 50 needs to grow on a per annum basis.
What about this flotation charges? So that is also for first year only. Na? For remaining years, we need not pay. Na?
Remaining years, we are not going to pay. So you're not understanding. You're taking it different way. If you get 931 today and you're supposed to be paying back 1050 after 5 years, then can I say you're paying 119 additional cost? Right? So that 119 is a cost for how many years?
Year wise we cannot take a sir charges amounts we cannot take a year wise.
No, because I want the average per annum cost.
Okay.
Okay. So this is average per annum cost. You cannot calculate cost for only 1 year, then 2nd year, then 3rd year. No, not like that.
Not like that. Year wise different amount coming means we can take different figures. Na?
No, it has to be average per annum cost.
Okay, sir.
Okay. Why are we not adding flotation cost in per annum cost and not spreading it over 5 years? Flotation cost is subtracted. Why should I add? I'm not going to receive this 49. I have to pay this 49, right? Right? So all these numbers will be given to you. All these numbers will be given to you. Don't worry. Redemption value, issue price, flotation cost, everything will be given to you. Because based on that data only, you're going to calculate the cost. Okay. Yeah, Srini.
Hello, sir.
Yeah, Srini.
Sir, why we are not calculated this cash flow time value of money?
Cash flow.
Time value of money, that is present value, annual cash flow.
That is not a method. What we are doing over here is, read it out.
Okay, fine.
Approximate method, right?
Yeah.
So we're just
So
trying
we
to
can
calculate
do.
in a easier way. Present value
Yeah, so we
calculation
can
is
do
the next.
alternate present value calculation also, right?
Yeah, that's the YTM or IRR method.
Okay, fine. Yeah.
Okay. So cost per annum cost of debentures is simply going to be the cost that you're incurring every year. So you are paying out interest. You're paying interest every year. So that's your cost. Plus the redemption value minus net proceeds. The difference between them, right? The difference between them is what the additional cost that you're incurring, and that is going to be spread over a period of 5 years. So we get the per annum cost of debentures as 123.8. What is flotation cost? I think you have joined late. Flotation cost is what I've explained. That is a cost that you incur to issue the debentures. Okay, like the cost of printing the prospectus, like the cost of fees that you're paying to the SEBI. All those initial issue expenses are the flotation cost. Okay. Now, the per annum cost of debentures is 123.8, but there is one shortcoming on this. There is one shortcoming in this. I cannot say that per annum cost of debentures is this because we need to first look at also the tax impact of it. Due to tax, this interest per annum cannot be taken as it is, 100. So suppose I tell you that tax rate is 30%. So due to payment of tax, your interest expense is a tax deductible expense. So whenever you're paying interest on that, you can get the tax deduction. Whenever you're paying interest, you can get the tax deduction on that. And therefore, I'm not going to take interest in my calculation. Rather, I'll say post-tax per annum cost of debenture. Post-tax per annum cost of debenture will be interest into 1 minus T plus the other portion, which is redemption value minus net proceeds divided by 2, divided by N, my bad. So we're going to take not directly the interest amount, but we are going to give it a post-tax adjustment. Like if I'm paying 100 rupees and if the tax rate is 30%, how much is the savings in tax that I'm having? If I'm paying 100 rupees and I'm having a tax rate of 30%, what is the amount of tax that I will save? What's the amount of tax that I will save? Can I say 30 rupees? So basically 100 rupees is paid, but essentially what is the, essentially what is the net cost for me because of that interest? Because of that interest, what is the net cost for me? Can I say 70%? Because you pay 100 rupee, but out of that 30% is a tax saving. Out of that 30% gets saved in the form of your tax saving, and therefore net cost for us will be only interest into 1 minus T. Net cost for us will be the 70% of the interest that we pay. Correct? So if we do the calculation here, there will be 100 into 1 minus 0.3 plus 1050 minus 931 divided by 5. So this will be 70 plus, or else I will just do the calculation here. What is the per annum cost, by the way, guys? Let's take 1 minus 0.3 from this, 93.8. Okay. Have we calculated the percentage yet? Have we calculated the percentage yet, guys? No. it is just in rupee terms. This number is just in terms of rupee. So rupee wise, because of this debenture, can I say the cost for us is 93.8 post-tax cost of debentures. Post-tax per annum cost of debenture is 93.8. Now I have to convert this to percentage. I have to convert this amount to percentage. How do I do that now? So obviously I need to divide it by something and multiply it by 100, right? Divide it by something and multiply it by 100. So my question is, I should divide this by what? I should divide this 93.8 by what number? By what number? Yeah. You should be dividing this by what? We will be to calculate the percentage per annum cost of debentures. We are simply going to take, sir, post-tax per annum cost of debenture. You divide it by average principal outstanding. Divide this by average principal outstanding. Post-tax per annum cost of debentures is going to be divided by average principal. Principal out. Like if you want to calculate any rate of return, rate of interest, what you do? Interest divided by the principal. Correct? That is what we do, right? When we want to compute the rate of interest, how do we do that? It is interest divided by the principal. Yeah. So what will be the percentage cost of debenture? Over here, we are going to divide it by average principal. Ajay Surya, I can't get the concept why there is tax. Why there is tax? Because we live in India, where we have to pay tax on our income, and we get tax deduction for our expenditures. Yeah. So when you're paying interest, you are going to save tax on it, right? So not only in India, we have many countries in India, many countries in the world where we are supposed to pay tax, right? So we are not living in a no tax world, right? So whatever is your income, you need to pay tax on it. If it's an expenditure, interest get money from our pocket. Ajay Surya, when you pay 100 rupee as interest, government says that this 100 rupees is your expenditure. Okay, government says that this 100 rupees is your expenditure, and you need not pay tax on this expenditure. So you have to pay tax on your net income, right? Not on gross income. So when you're calculating your income tax, you will subtract this 100 rupee and there will be a tax saving for you. Okay. Clear? Correct? So ultimately we must pay, you pay 100, but then you save 30. You pay 100, but then you save 30. So what is the net cost for you? Yeah. What is the net cost for you? 70, right? So that is a 70. 70 is your actual net expenditure. Got it? So let's say you have someone special, okay, and you gift her, let's say a gift worth 1,000 rupees, and she gifts you back, he or she, whatever, some special friend, he gifts you back, let's say, gift worth 400. So what is the net cost for you? What is the net cost for you? The difference, right? So you paid 1,000 and you received benefit worth 400. You paid 1,000 and you received back benefit worth 400. So net cost for you is 600, correct? It's the same fundamental over here. 100 rupees is what you're paying, and on that you are having a saving of 30 rupees as the form of tax. Okay. Now we haven't yet covered this. Sanatan, just relax, keep calm. JB is here, so we haven't yet covered average principal. Okay, so post-tax per annum cost of debenture is average principal. Now, to understand this average principal concept, let me just take you. Let me just give you another this case over here. Let's say year, and if I ask you, what is the principal outstanding? Year 0, what is the amount of principal outstanding? How much did you borrow in year 0? How much did you borrow in year 0? How much did you borrow in year 0? In our example, what is the amount that you received in year 0? I mean, today, how much is the amount that you're going to get? Can I say 931? Right? Then you have like year 1, 2, 3, 4. By the end of 5th year, this principal outstanding of 931 would have become how much? Would have become how much? By the end of year 5, how much would be this 931? The amount that you received as 931 today, how much are you supposed to pay back? Can I see you have to pay back 1050, right? Principal outstanding end of 5th year before redemption. Just before redemption, can I say 1050 is still outstanding? Am I right, guys? You received 931 today, and you are going to pay back 1050 after 5 years, right? And now rupee per annum cost. Rupee per annum cost. This 931, did it become 1050 all of a sudden, or are we going to increase the principal gradually? 931, did it become 1050 all of a sudden? Overnight, did it change 1050? Can I say there is a gradual increase in it? Right? So can I say 931 added to it, this particular portion, some portion is getting added to it. What is that? 119 divided by, because the difference was 119, right? 119 divided by 5. So every year it is going to increase by 23.8, correct? So 931 increase by 23.8. Then again this increase by 23.8. Then again this one increasing by 23.8. And then again this one increasing by 23.8. Can I say there is a gradual increase in the principal outstanding? Am I right, guys? Yeah. Now, when in the first year, when you're saying that your cost is 93.80, in the first year, when you're saying that your cost is 93.80, can I say your principal outstanding in 0th year was 931? Can we say we had a cost of 93.8 on principal of how much? On principal of 931. Okay. Again, next year we had 93.8, but this is a cost on principal of how much? Can I say 954.8? Again, we had a cost of 93.8, but this is on a principal of how much? This is on a principal of how much? Can I say 978.6? Now, once again, we had 93.8, but now this is on a principal of, can I say 1002.4? And then finally, one more time we had 93.8, and now this time the principal is on, on a principal of 1026.2. Correct, guys? So can I say in each of the respective years, your interest amount is constant? Your interest, sorry, not interest, my bad. Your rupee per annum cost or INR cost per annum is constant. But can I say your principal is gradually increasing every year? Can I say your principal is increasing gradually every year? So if I want to get an average cost of percentage per annum cost of debt, instead of just taking the initial principal, it's wrong to take initial principal, and it's wrong even to take the final redemption value also, right? So therefore, instead of considering just the opening principal, what we do is we consider the average principal. We consider the average principal. Now, average principal can be simply calculated as, the numerator part. Can I say the numerator part is nothing but this number, that is interest into 1 minus t plus redemption value minus net proceeds by n. Correct, guys? The numerator part. Can I say numerator part is this? Right, guys? This is what we have got, right? 93.8. Numerator part is this. Okay. Now, denominator part. How do we get the denominator part? Denominator part is average principal. How do you calculate average stock, by the way? How do you calculate average stock or anything average for that case? Can I say opening plus closing divided by 2? So what's the opening over here? Opening is NP. What's the closing value? It's the redemption value. So simply divided by 2. Right? Opening plus closing divided by 2. So net proceeds plus redemption value by 2. You know what, guys? I have just explained you the logic and the magic of cost of capital. The simple method, or the approximate method formula for cost of debt, that's interest into 1 minus t plus redemption value minus net proceeds divided by n, the whole divided by net proceeds plus redemption value divided by 2. That KD is indicating cost of debt. Now let's just put up the values, guys, without any more delay. So that 93.8, and what will be the redemption value plus net proceeds? It's 1050 is the redemption value, plus net proceeds was 931. Then we divide it by 2. So finally we have this as 93.8 divided by 1050 plus 931 by 2. That's 990.5. And so percentage is, in percentage terms, this works out to be 9.47%. Hardik, we can also call it hit and trial method. No, Hardik, this is not hit and trial. Where did we hit? And where did we even try? There is nothing hit and trial over here. Okay, it's an approximate method. Hit and trial is the next method that we will do. Okay, what if there is no redemption? We'll come to that. This is a case where we have the redemption value, that the bond is having a definite tenure. This is a case where we are looking at the bond is having a definite tenure for the redemption. If there is no redemption, then obviously irredeemable debenture is what we are going to look at. Okay, so this is a case where we are looking for cost of debentures if they are going to be redeemed. Now, what would be the cost of debentures if they are irredeemable? Cost of irredeemable debentures. Cost of irredeemable debentures, guys, it's very easy. Since there is no redemption, nothing, what we are going to say is it's just interest into 1 minus t, that's the 1 minus tax rate, and divided by the net proceeds. That's it. That's the simple formula for cost of irredeemable debentures. Since there is no redemption value, only whatever interest is you are going to pay, 1 minus t, that's going to be divided by the net proceeds. Okay. Why we subtract the numerator? Sanatan, Mr. Sanatan, you want to get the percentage per annum cost. So it has to be the cost divided by the principal amount. I need to divide it by the principal amount to get the percentage, right? Because it has to be a percentage of something. Okay. Okay. So that's the cost of irredeemable debentures and the cost of debentures. Why isn't there in net proceeds in numerator in irredeemable? How will you have net proceeds when there is no redemption value? When you don't have a redemption value available because the debenture is not redeemable, or debenture is going to be in perpetuity. So whatever net proceeds I get and the principal amount to be repaid, that is not specified. So this entire portion is not defined. Your redemption value is not defined. So even redemption value minus net proceeds upon n is also not defined. Got it? क्या बोलते हैं? ओके सर, क्लियर है. कॉलेज जब पढ़ा था टीचर से फॉर्मूला लिख कर चले गए थे. ओके, अभी तो क्लियर है हार्दिक, एकदम परफेक्ट दिमाग में. यस, ओके. नाउ what we did is cost of debentures. Okay, cost of debentures आ गया, which is cost of irredeemable debentures, which is interest 1 minus t, और वो कर लिया हमने. Now the next part is to get the cost of preference share, guys. Tell me, when we are talking of preference shares, अनिरुद्ध नायर, इरिडीमेबल डिबेंचर को हम इक्विटी शेयर में कन्वर्ट करते हैं और उसमें भी कॉस्ट तो होगा. तो भाई अनिरुद्ध नायर, मिस्टर नायर, यू आर heavily under wrong information. Irredeemable debenture doesn't mean getting converted to equity shares. Those are convertible debentures. We are not talking of convertible. We are talking of irredeemable debentures. Irredeemable means प्रिंसिपल कब रिटर्न होगा सर, और डिबेंचर कब तक रहेगा सर. Till what duration debenture is going to be there, right? So the answer is debenture तब तक रहेगा जब तक है जान. ठीक है? So till the company is existing, the debenture is going to be there. Principal is not going to be repaid. Okay. So convertible debentures, yes, convertible debentures, whatever is the value of shares you're going to give to your debenture holders, that will be the redemption value. Okay. Now, cost of preference shares, again we are going to using approximate method. Okay, cost of preference share, approximate method. Cost of preference shares using approximate method now. So here we have this cost of debt using approximate method is done. I'll just take this formula and I'm just going to revise it a bit. So here we stated that it's going to be interest into 1 minus t plus redemption value upon plus redemption value minus net proceeds divided by n. But the idea is preference shares, can I say the payment to the preference shares are similar to that of debenture holders. We just change the name. Instead of saying that we pay interest, we say that we are paying. What are we paying? Instead of saying that we are paying interest, we say that we are paying dividend, right? But can I say pattern of payment is similar? They're not like equity shareholder that they will not ask for any dividend. Preference shareholders are very much selfish. They will definitely ask for the dividend. The moment you are not paying for the dividend, they may ask you for winding up of the company also. Okay, so formula over here, cost of preference share, I cannot write interest into 1 minus t. Instead of writing interest into 1 minus t, what should I write, guys? Can I write preference dividend into 1 minus t? Can I write preference dividend into 1 minus t? No, I cannot write preference dividend into 1 minus t, correct? Why can't I write that preference dividend into 1 minus t? Because preference dividend, when you pay, you are not getting any tax deduction, because preference dividend is treated as, I think these two sentences you might have learned, preference dividend or payment of dividend is treated as charge on profit or appropriation of profit. I hope you might have learned these two words, charge on profits and appropriation of profit. Yes. So what is a preference dividend? Is it a charge on profit or is it an appropriation of profit? Preference dividend, is it a charge on profit or is it an appropriation? It is appropriation. And in fact, if you could recall the income statement that we had, we start with EBIT, then interest, then you get PBT, and then on PBT you pay tax. And then you get the profit after tax, correct? So already, sir, preference dividend is not allowed for tax deduction purpose. And therefore, this formula gets revised, right? Instead of taking it as preference dividend into 1 minus T, it will be only preference dividend. Okay. Meet is asking, explain charge and appropriation. Okay. Appropriation is basically when you have profits, then only you can make the payment of that. Without profits, can you make payment of dividend? Without profits, can you make payment of dividend? No. But even if you don't have profits, will you charge depreciation on the assets? Even if you don't have sufficient amount of sales, will you book your expenses? Will you book the salary payable? Of course, yes. So that's the charge. The charge means by hook or by crook, you have to put it in your P&L debit side. But in case of dividends, in case of transfer to general reserves, you cannot do it unless you have sufficient profits available with you. Got it? Okay. So cost of preferential, we say preference dividend plus RV minus NP by 2. And this is going to be NP plus RV by 2. Now tell me, what will be the cost of preference shares for irredeemable preference shares? Anyone tell me? What will be cost of preference for irredeemable preference share? It will be just preference dividend divided by net proceeds and nothing more than that. And nothing more than that, right? So all of them are, numbers which is going to be expressed in terms of percentage per annum. Okay, theoretically, we may not have irredeemable preference shares or irredeemable debentures. Practically, we may not have it, but we are just learning it conceptually to calculate it in a easier way, right? So theoretically, we are learning. We have certain countries where these irredeemable debentures and preference shares are allowed. Okay, so we are not learning this subject, specifically to the Indian context. We're looking at in the global context. Convertible debentures, we'll do it later on, Hardik, when we have a numerical with that, when we have a question based on that, we'll be doing it. Okay. So right now, convertible, the only idea I can say is the redemption value will be replaced with the amount of convertible shares that you're going to get, or the value of shares that you're going to get. Okay. Clear? Shall we do a practical problem now? A quick practical problem to solve. Yes. Okay. So let me just place it here. Instrument, term, issue price, then redemption, face value. Dishika, just hold on. Convertible shares, whenever the debentures are going to get converted, whatever will be the value of debentures that you will get, that will be taken as the redemption value. The value of shares that you're going to get against the conversion, that will be taken as the redemption value. Okay. open rate, and redemption issue price. Then we say flotation cost. Okay, instrument is, let's say, irredeemable venture. Or why should I write irredeemable amount? Debt, preference share, debt, preference share. So let's say the term is 6, 8. ND stands for not defined, guys. ND stands for not defined. I hope you understand. Not defined means, is it a redeemable instrument or irredeemable instrument? When the redemption date is not defined, it's obviously irredeemable. Issue price, let's say 94, 970, 0, 50. Redemption is at 100, 0.020, 1000, and 05. Face value is 100, 1000, 1000, 1000, 100. Open rates are 12%, 14%, 15%, 7%, 8%. Rotation cost 1%, 2%, 10%, 0%. Preference share 0%. Okay. Take the tax rate to be 30%. I want you guys to calculate the cost in percentage per annum. So basically, I want you to calculate the cost of debt and the cost of preference share for the respective instrument. Can you calculate it, guys? Can we calculate this using the same formulas? I'll just place the formula over here. Okay, this is the cost of debt, cost of irredeemable debentures, okay, then the cost of preference shares, okay. Here we have it fully. You can just look at the screen, try to solve it. Post that, you can simply take a break, and then post break we'll be discussing this. Okay, you can just take it down quickly, and once you have taken down this question, then I'll declare a break. Write down this entire table quickly, guys. Post that, I will declare a break. Tax rate is given. Tax rate is 30%. Stated over here, see. Just let me know once you have copied this. Let me know once you have copied this. Then I can declare a break accordingly. Screenshot taken. You can take the screenshot. Yes, that's the best thing. Taken screenshot. Okay. So then ND means irredeemable. Interest should be taken on face value. Of course, yes. Took a screenshot. Okay, fine. Then let me just declare a break. Let's take a break, guys. A break of 10 minutes. After that, we'll meet up to discuss the solution for this and then really go for an interesting method to calculate the cost of debt, which is the YTM or IRR method. Yes, please, Sai Kiran Kumar. What's your doubt?
Sir, previous problem, you have calculated rupee per annum cost for all the 5 years. 931, 954, 978, 1002, 1000. But that is not in the solution, sir. That is not used in the solution.
No, that's not using a solution. That was just to explain why are we taking average.
And next, cost of irredeemable debentures, that answer was not calculated, sir.
No, there was no question only. So where will the answer come? I haven't given
Huh?
you any question. I haven't given you any question on irredeemable debentures over here. Okay.
Sir, this
There is no questions
rupee
or no
per
solution.
annum cost will not be useful, sir. Only for calculation purpose.
Yeah, only for explaining the logic behind it. Nothing.
Not useful in solution.
No. Solution is only this much, what you can see. Okay, so all other thing is just to understand the concept and to get the logic. Okay. Yes, Srini. Srini.
Hello, sir.
Yes, Srini.
Yeah. So, is it possible that the redemption value is less than net proceeds?
Yes,
And
it
if
is possible.
why companies do like this? Thank you. Yeah.
Yes. Okay, let's look at the answers. The first one, that's going to be interest. So 12 multiplied by 1 minus 0.3. This is the tax rate. So interest into 1 minus t. Correct? So I can say this is 12% of face value into 1 minus 0.3 plus redemption value minus net proceeds. So net proceeds will be 94 into 1 minus the flotation cost, right? And then this entire thing is divided by redemption value plus the net proceeds, redemption value plus 2 price into 1 minus this divided by 2. First one, check if it's 15 point this number. Divide by the term, yes. %9.90, 9.90, 9.91. Yeah. Yep. So how to solve. You didn't understand. First question. We have already done this. Let me just do it manually for you guys. Once you get an idea how to do the manually, and then we can apply the other formula. So first I need to get the net proceeds. The net proceeds is issue price minus flotation cost. So issue price is 94 minus flotation cost, which will be 1% of 94. Okay. $94 into 1%, which is 0.94. So minus 94, this will be 93.06. Net proceeds is 93.06. Okay. Then that's the net proceeds. Redemption value is already given 100. Correct. Then interest. Interest is 12% of face value, which is 12 rupees. So cost of debt will be interest into 1 minus T plus redemption value minus net proceeds by the number of years, the whole upon redemption value plus net proceeds by 2. So interest is 12 into 1 minus tax rate was 0.3 plus redemption value is 100 minus net proceeds is 93.06 divided by 12, sorry, divided by number of years is 6, the whole upon 100 plus 93.06 divided by 2. That is 12 into 0.7, 8.4 plus 100 minus 93.06 divided by 6 is 1.1667. The whole divided by 100 plus 93.06 divided by 2, which is 96.53. 8.4 plus 1.1667. This comes out to be 9.5667 upon 96.53 divided by 96.53. Yeah, that gives me 9.91%. Correct? Are we getting this, everyone? Yeah. Now let me just quickly show you the answers for this. Second one, it is 10.9. Third one, since this is a case of not defined thing, it's simply going to be the coupon rate, which is 15% of 1,000 divided by the net proceeds is 14.71. Then for the next one, it is 70, which is coupon rate is 7% of 1,000, 70 divided by 1050 into 1 minus 1%. So is it 6.73? Oh, sorry, it will be after tax, right? So 70 multiplied by 1 minus tax also will be there. We have 4.71%. And last one, is it 5.95? Fifth question. No, it will be different, correct? Because there is no tax benefit. So 8.29. 8.29. Correct? Did we get all of them correct? There में flotation cost क्यों नहीं लिया? Because there is no flotation cost. There may be flotation cost, there may not be also. It was given in the question. It may be a situation you don't have any flotation cost. Even it is possible in case of debentures. Okay. Fine. 8.4. 8.4 कौन सा है बेटा? Preference share which one? The irredeemable or the redeemable one? Which one, Tambeshwari? Anyone? Okay, I'll do this. The redeemable one. These are the numbers available. Okay, so here the net proceeds, issue price is 100, flotation cost is 0, the net proceeds is 100, the redemption value is 105, number of years is 10, then preference dividend is 8%, so 8 rupee. The cost of preference share will be preference dividend plus RV minus NP upon number of years divided by RV plus NP by 2. So it is RV, I mean preference dividend is 8 plus redemption value of 105 minus 100 divided by number of years is 10 upon 105 plus 100 divided by 2. So this is 8 plus 0.5 divided by 102.5. The answer is 8.5 divided by 102.5. 8.29%. Got it? Yes, everyone? Okay. Now it's time for us to look at the next method, which is IRR method. Okay. So next method. Cost of debt using IRR method, or this is also called as YTM method. Okay, so cost using IRR or the YTM method. Now, how do we deal with this? Yeah. Now, what is for that? We'll need to understand what is YTM and what is IRR as such. We'll understand it with a very basic sense. Okay. Like for example, suppose I take the case of this question itself. This question itself. Okay, so we're looking for a bond or a debenture with a face value of 1,000, which is going to be issued at 980. Redemption is 1050. Term is 5 years. Interest or coupon rate is 100 rupees. Flotation cost is 49. So we get a net proceeds of 931 and tax rate is 30%. Okay, so we're going to use this same data for our calculation purpose. But before we go ahead with the calculation purpose, let me just do a bit of time value of money with you. Yeah. Will you share this solved answers? Yes, I'll be uploading this. Let us do a time value of money concept. Let's see how many of you really remember it. If I say that your principal, suppose the principal value is rupees 900, okay, and the accumulated value principal is rupees 900, and let us say the accumulated value that we have is, let's say the accumulated value is rupees 1350 after, let's say, 2 years. Accumulated value is, suppose, 1350 after 2 years. Then can you compute the rate of interest applicable here? Can you compute the rate of interest? Can we compute the rate of interest? Are we aware of the compounding formula, right? Compounding. Simple interest, not applicable. We're talking of compound interest. So can I say A is equal to P into 1 plus I raised to N? This is what the formula is to get the compounded amount. So can I say this is 1350 is equal to principal into 1 plus I raised to 2. So now the principal is of course 900. So it becomes 1350 divided by 900 is equal to 1 plus I square. Correct? So what will be the number? 1350 divided by 900. 1350 divided by 900, which is 1.5. So 1.5 is equal to 1 plus I raised to 2. So what will be the value of I? 1.5. Can I say we need to take the square root, which is 1.2247. That's 1 plus I. So I will be, can I say 22.47%. Rate of interest, I will be 22.47%. I hope you are aware about these calculations, guys. Right? You are aware about these calculations? Yeah. Okay, let me just try out one more with you. Suppose amount borrowed. Acha, before this, amount borrowed. Let's say borrowing is rupees 95. Repayment of this is suppose 150, and term is suppose 4 years. Can you tell me what is the rate of interest? Can you calculate and tell me? Can you calculate the rate of interest over here? If your borrowing is 95 and repayment is 150 after a period of 4 years, what is the rate of interest? $150 equal to 95 into 1 plus I raised to 4. So 150 divided by 95 is equal to 1 plus I raised to 4. $150 divided by 95, right? So this is 1.5789 is equal to 1 plus I. This is, of course, raised to 1 by 4. So fourth root is 1.1209. This 1 plus I. So I will be 12.09%, correct? Am I right, guys? 12.09%, correct? I hope you remember this formula and the method to calculate the rate of interest. Calci how 1 by 4? 1 by 4 will be simply pressing the square root 2 times. Press the square root 2 times, you will get the... Okay? Fine? Then, now let me take it the other way around. We are going to borrow, let's say rupees 150. And repayment is going to be, let's say 200 over a period of 3 years. Or let me take it over a period of 2 years. Calculate the rate of interest. Calculate the rate of interest. Calculate the rate of interest, guys. Can I say you did it like this? So 200 is equal to 150 into 1 plus I raised to 2. Correct? Am I right, guys? Okay, so 200 is equal to 150 into 1 plus I square. Can I write the amount that is happening in value in year 0, or I can say cash flow in year 0, and this is your cash flow in year 2. Can I write this as cash flow in year 2 is equal to cash flow in year 0 into 1 plus I raised to 2? Yeah. Cash flow in year 2 is equal to cash flow in year 0 into 1 plus I square, correct? So can I say, sir, cash flow in year 2 divided by 1 plus I raised to 2 is equal to cash flow in year 0. Pallavi, can you explain the logic behind 1 plus I? Pallavi, the compound interest formula. Amount is equal to principal into 1 plus rate of interest raised to n. That's a basic thing. I mean, foundation, maybe 9, 10, 10 standard also you might have learned. It's just the compounding factor getting added. So cash flow in year 2 upon 1 plus I square is equal to cash flow in year 0. So therefore I can say that cash flow in year 0 is, or you can say, you can make it like this, that 150 is equal to 200 divided by 1 plus I. And then you, of course, this is square, so you can solve it. Right? So now suppose we have a debenture. Okay? This debenture is having a term of 2 years. Net proceeds are rupees, let's say 980. Redemption value is, let's say, 1000 rupees. Coupon or the interest is, let's say, rupees 80. Okay, we are not bringing the tax as of now. If I apply the formula, cash flow in year 0 will be equal to what? Take a help from this particular formula, cash flow in year 2 wala thing. Take help from this. Tell me what cash flow in year 0 will be equal to. Cash flow in year 1 divided by 1 plus I plus cash flow in year 2 divided by 1 plus I square, correct? Cash flow in year 1 divided by 1 plus I plus cash flow in year 2 divided by 1 plus I square, correct? Because when you had only one single cash flow, you said cash flow in year 0 will be equal to cash flow in year 2 divided by 1 plus I square. But here, since the tenure is 2 years, this is going to be having a cash flow of 2 times. Correct, guys? Yes or no? From this debenture, what is going to happen, sir? In year 0, we are going to receive 980. Then in year 1, we are going to pay 80 rupees. In year 2, we are going to pay 1080 rupees. So how many cash flows are happening in this debenture? 2 cash flows. One in 0th year, right? Sorry, 3 cash flows rather. One in 0th year, one in 1st year, and one in the 2nd year. Correct? Now cash flow in year 0 is 980. Cash flow in 1st year, it is going to be 80. 80 divided by 1 plus I plus cash flow in the 2nd year is 1080 divided by 1 plus I square. Can you solve this equation to get the value of I? I want to know what is that rate that's applicable here. Can you solve this to get the value of I? Can you solve this to get the value of I, guys? Please try to solve this to get the value of I. I can give you a couple of minutes to solve. Try to solve this equation to get the value of I, guys. First year 80, take Y. First year, because this is a debenture, tenure is 2 years. So if you are issuing this debenture, you need to pay the coupon, right? You need to pay the coupon. Coupon is 80 rupees per year, which is the interest amount which you have promised to your investor. Yeah? Got it? Yeah, okay. So tell me, give me the value of this I, guys, by solving this. Let me see who's the wizard who can really solve this mathematical equation. Give me the value of I. Anyone? Are you able to solve this to get the value of I? $18.36. Really? Are you serious? 18.36. 15%. Anyone else? 18.36, 8.63, 8.16. Yeah. Anyone getting it? %20. No. You know what, guys? Are you trying to solve this equation by, opening the 1 plus I the whole square in quadratic form? Are you trying to solve it by opening it in quadratic form? Sorry, guys, but that cannot be used to solve this question. Right? So if it is square, now tomorrow we may have cube, we may have raised to 4. Right? So what if it's a 3 equation, like 80 upon 1 plus I, then 80 upon 1 plus I square, then 80 upon 1 plus I cube. So it's cubic, or, maybe raised to 4, raised to 5 equations. So you cannot solve it essentially. So let's learn a different technique. Let's learn a different technique to solve this. Right? So let's learn a different technique. So that technique is called as a YTM or IRR method. Yeah, someone was saying hit and error or trial and error method, right? So let's solve it by using the only method available, which is trial and error. Let us assume for I equal to, let's say, 10%, or I equal to 10%, what is going to be our RHS? What for I equal to 10%, what is going to be the RHS? 80 upon 1.1 plus 1080 upon 1.1 square. So give me the RHS value. So for if your rate of interest is 10%, what is the value of this? 80 upon 1.1 plus 1080 upon 1.1 square. What is this value is? 80 upon 1.1 and 1080 upon 1.1 square. What's the value? $80 divided by 1.1 is 72.7272. Then 1080 divided by 1.1, again divided by 1.1 plus 72.727. How much is this? 965.28. 965.28. But what is the value that we needed? What was this value supposed to be? We got it as 965.28, but what is the value that we are targeting? We are targeting the value of 980. Correct, guys? We are targeting the value of 980. So now when I'm taking the rate of interest as 10, I'm getting this as 965.28. I'm getting this as 965.28. So which is not actually matching with the number, because we want the value to be 980. So now when I want, so what am I looking at the value of RHS? Do I want to increase it above 965 or do I want to reduce it below 965? What is my objective? What is my objective? I want to increase it, right? So if you want to increase it, you're going to reduce the rate of interest. So let me just check what is happening at 5%. So at 5%, what's the RHS? At 5%, what's the RHS? So 80 divided by 1.05 plus 1080 divided by 1.05 square. Give me what's this number? Give me what is this number? Your I is 10%. We got this as 965.28. Now, if I is 5%, what is the RHS value? So for 5%, what is the RHS value? 1055.78. We got this as 1055.78. RHS is 80 upon 1.05 plus 1080 divided by 1.05 square. That's equal to 1055.78. Correct? Now, can I say we were targeting for, we were actually targeting for what value? We were targeting for a value of 980. But our initial value is 965.28 and this is 1055.78. 965.28 is what we got at a discount rate of 10%. And at 5%, we're getting this as 1055.78. Correct, guys? Correct, guys. So between 965.28 to 1055.78, between 965.28 to 1055.78, there is a middle value called as 980. Right? So there is this middle value called as 980. I want to know what is this rate of discounting, X%. What is the rate of discounting? That is something which I want to know. How do we get that value of X%? So for that, pay attention, guys. Very careful attention, guys. Everyone, please pay attention. How to get that X%? There is a formula for this, but I'm not going to follow the formula. I'm going to give you the logic for that. Okay. Can you tell me in terms of percentage, what has been the change? In terms of percentage, what has been the change? From 10% till 5%. How much is the change? Can I say there is a minus 5% change? Correct? Because we have reduced, right? So percentage change is minus 5%. Then what is the change in the value? Like value has changed from 965.28 to 1055.78. So what is the percentage? What is the amount change? What is the change in the value? Can I say it is plus how much? Positive 90.50. Correct, guys? Am I right, guys? Are we getting this? When the rate changed from 10 to 5%, that is a reduction in the rate by 5%, the value increased by 90.50 rupees. But tell me, did we really want the value to be increasing by 90.50? How much was the required increase in the value? How much was the required increase in value? Can I say from 965.28 to 980? From 965.28 to 980, what is the value that you wanted to change? Can I say required change was 980 minus 965.28? 980 minus 965.28. So this is like plus, we wanted to change it by 14.72. So now, can you simply do a cross multiplication and give me the percentage by which you were looking to change it? Like we were looking for what percentage change from 10%? Do the cross multiplication and tell me the number. What's the cross multiplication? Yeah. After cross multiplication, what's the number? 14.72 divided by 90.5. 14.72 multiplied by 5 divided by 90.5. That's, can I say, minus 0.8133%. Correct? So this should be actually changing by minus 0.8133%. Minus 0.8133%. Correct? So can you tell me what is the value of the I? Can I say originally it was 10% and we want to reduce it by 0.8133%. What is the value of I that we are getting? 9.1867%. Yes. Correct, guys? And this 9.1867 is the rate of interest. Yes. Change in rate. Last two steps. Okay. I'll do it again. I'll do it from the beginning. See. Is this part clear as of now? Whatever is on the screen? Yeah. So at 10%, we got a value as 965. At 5%, we got the value as 1055.72. So when we were looking at from 10% to 5%, from 10% to 5%, there is a reduction. From 10% to 5%, there is a reduction of 5% in the rate, and the value is increasing. The increase in value is what we have observed. The increase in value is plus 90.5. Okay. Now, what is the increase in value that we really wanted? How much increase in value did we require? What was the increase in value that we wanted? What is the increase in value that we require? We want to increase it from 965 to 980. We want to increase it from 965 to 980. So can I say required is 980 minus 965.28. So by what value should the, by what number should the value increase? 14.72. Correct? Now do a cross multiplication to get the percentage change. Simply do a cross multiplication to get the percentage change. Do a cross multiplication. Hence it is minus 0.8133%. Minus 0.8133%. Yes. Correct. Yes. कौन था वो जिसको नहीं समझा था? Nishika. Got it? Okay. Now this is minus 0.8133%. So what will be the value of the rate? So I will be, can I say 10%? Instead of subtracting it 5%, we will subtract just 0.1833% to increase it by only 14.72%. So this is 10% minus 0.8133. How much is it? 9 point, 9.19 or 9.118, yeah. 9.1867. Got it, Deshika? Yeah. Acha, what should be the assumption first value, sir? You can take a number which is around the coupon rate. Approximate whatever is the coupon rate, like 80 is the coupon over here. So approximately 8 ke aspas up you can take, like instead of 8, you can say 10 and then see whether to decrease it or increase it. Okay. Now, shall I give you one more question like this to calculate the rate? Yeah. Coupon is the interest rate. Yes. Interest rate, which is on the face value that they are paying. But the actual rate of interest that is being charged to you is 9.187. 1055 say difference. Because we were looking from 10 to 5, right? When my movement was from 10 to 5, I'll be obviously looking from 965 onwards. Kitna hai? Got it, Tambeshwari? We were looking at initial rate was what? 10%, right? So 10 to 5 hum dekh rahe hain. Okay, now you can just try out this question for your practice, guys, to get the IRR. Again, we are talking of a debenture with a term of, let's say, 2 years, or let me take it as 3 years. Net proceeds is 990. Redemption value is 1000. Coupon is 100. Yeah. Or let me take this as maybe redemption value is 1050. Yeah. Coupon is 100. Can you calculate it? Can you calculate the rate over here? Yes, guys. Can you calculate the rate over here? Yes, please proceed and give me the rate using this same method. Till that time. Yes, B. Sai Kiran.
Sir, previous solution we got now by taking base 10% and 965. Whether it can be done with taking 5% and 1055 as base, and can we do the results, sir?
Yes.
Can we get the result?
Yeah, you'll get the same result.
Can you show that, sir, please?
You take base as 5, then the change instead of minus 5, it will be plus 5%. Correct?
How it is to be, no, that calculation we have to do, no, sir, how it is to be done?
Percentage change and percentage value. So if you're taking it from 5 to 10, it means you're increasing the percentage by plus 5%.
Yes, sir.
Correct? And the change in value is by 90.5 minus.
Yes, sir.
Right? What is the change that we need in the value now? From 1055.78, we want to reduce it to 980.
75, sir, minus 75.
Minus 75.78.
58. 78.
78. Then you do the cross multiplication to get this rate. Do the cross multiplication to get this rate. What's the cross multiplication number? 75.78 into 5 divided by 90.5, which is 4.187. So we need to add it. So 5% plus 4.187. That gives you the same 9.187.
How this 4.187 came, sir?
Cross multiply. 5% into minus 75.78 divided by 90.5.
Divided by
90.5. Cross multiplication, yeah.
Minus 75.78 by 90.5.
Yeah.
Into 5%.
See, it is 5% multiplied by minus 75.78. So just do only 75.78 and then divide it by 90.5. Ignore the sign.
Okay.
Cross multiplication.
Okay, then we will get 4.187. Okay.
Yes.
Okay, sir. Thank you.
Yeah.
So we can take either way. We can take. We need not
Yes,
take one
yes.
side like that. It is an
No, either way you can do this.
Eh?
Yes, either way you can.
We can take either side, sir.
Yes.
Okay, thank you, sir.
Yes, Sanatan.
Hello, sir.
Yes, Sanatan.
Sir, you wrote in the board the coupon rate, or can say interest is 100. Is there 3-year combined interest?
Yeah, 3 years. Term is 3 years. Coupon is 100. Yeah. Three years we are going to get this. Your equation will be 990 equal to 100 divided by 1 plus I plus 100 divided by 1 plus I square plus 1150 divided by 1 plus I cube. This is going to be your equation. Okay, so in the last year, you will get the coupon as well as the redemption value. Yep. Try it out with first at I of 10%. Look, what is the RHS? 100 divided by 1.1 plus 100 divided by 1.1 square plus 1150 divided by 1.1 cube. What is this number at 10% if you would have done it? How much is this number? At 10% it is 864. At 10% it is 864. Or is it something else? Is it something else at 10%? Let me just throw it in Excel. Try to see what's the answer. Will be 100 divided by 1.1 plus 100 divided by 1.1 square plus 1150 divided by 1.1 cube. Okay, that's 1037. Okay. So at 10%, this is 1037. Okay. Now try it out with at I equal to 15%, because we want to reduce this 1037 to 990. So try it out with 15%. Your RHS will be equal to at 15%, it is 918.5. So again, we have got two values between these two. Right. So at 10%, we had 1037.57. At 15%, we got 918.72. Then in between, we want it to be equal to 990. So we'll look for the percentage change and the value change. Percentage change is right, increase from 10% to 15%. So we'll say there is a percentage change of 5% from 10 to 15. Then the value change that has happened is, it has reduced from 1037 to this, to 118. What is the value that we were really looking to change? We wanted to change the value by 47. So percentage change will be 0.02, or sorry, 2%. Correct? If it's 2%, then your cost of debt will be 10% plus 2%. That's approximately 12% is the answer. Approximately 12, 12.2, 12.17. By cross multiplication, you may get some different numbers due to approximation error. Okay. Fine. So with that, we are through with our quota of concepts. Yes, Hardik.
Sir, sir, I have also used the same method, but sir, my answer is 13%, sir.
13% is. What is the change in value? 118.851.
सर मैंने सर स्टार्टिंग में 15 लिया और बाद में 10 लिया, तो सर कोई फर्क तो नहीं पड़ेगा?
फर्क पड़ेगा ना बेटा।
अच्छा, मतलब पहले छोटा नंबर लेना?
कोई भी ले सकता है। वैल्यू चेंज तेरा कितना आया? 118.851 पॉजिटिव है नेगेटिव है?
सर मेरा पॉजिटिव है 119।
119 पॉजिटिव है, तो तेरा परसेंटेज चेंज नेगेटिव रहेगा,
-5%।
हाँ, तो ये आंसर कितना आता है फिर उससे?
71.5%।
ये चेंज कितना है? व्हाट इज चेंज दैट यू नीड? 47 पॉजिटिव ना?
सर मेरा है प्लस 71.5।
यहाँ पे कितना चाहिए रहेगा?
प्लस 71.
हाँ, तो यहाँ पे नंबर क्या आया? परसेंटेज चेंज पॉजिटिव है नेगेटिव है?
सर पॉजिटिव आया।
पॉजिटिव कैसे होगा? नेगेटिव होगा ना बेटा वो।
हाँ सर, नेगेटिव आया, लेकिन सर वो सॉरी नेगेटिव आया, लेकिन सर 10 - 3 7% आ रहा है फिर मेरा।
10 - 3 कहाँ से करेगा रे मेरे भाई? परसेंटेज चेंज इज व्हाट व्हेन यू आर टेकिंग, कहाँ से कहाँ जा रहा है तो पहले ये बता। 10 से 15, 15 से 10।
सर मैं 15 से 10 जा रहा हूँ।
हाँ, तो परसेंटेज चेंज -5% हुआ ओरिजिनल।
यस सर। और सर 918.5 से 1037
वैल्यू चेंज विल बी
119।
इंक्रीज हो गया ना?
हाँ जी सर।
118.85 119 हुआ रहेगा। नाउ व्हाट इज द वैल्यू चेंज दैट वी नीड?
सर 990
990 माइनस ये ना, तो अपने को 71.28 चाहिए नया चेंज।
यस सर, 71 -3%।
परसेंटेज चेंज दैट वी आर एक्सपेक्टिंग -5, राइट? सॉरी -3%।
यस सर, यही आ रहा है मेरा।
हाँ, तो -3% है, लेकिन तेरा स्टार्टिंग वैल्यू क्या था? 15% से स्टार्ट किया ना तू?
यस, हाँ
15
15%।
-3 करेगा तो 12 भी तो आता है।
ठीक है सर, ठीक है, थैंक यू सर। थैंक यू सर।
रमेश्वरी।
सर ये 10 से 15 यही 5% ले रहे हैं ना हम? 5% जो माइनस किया है।
यस यस, ये
Yes.
-5 इज फ्रॉम 15 to 10। ऑपोजिट
Okay,
वे, इफ यू आर डूइंग इट फ्रॉम 15 to 10।
यस सर, इसलिए मेरा मिस्टेक हो रहा था बार बार। Thank you, sir.
Okay. Yes, Ratimalini.
Sir, I can't understand that cross multiplication, sir, that change in value.
Cross multiplication you can't understand.
The change in value
Hmm.
that I can't
What?
understand. I found out the change percentage and change value, but after that, how to
How much is this?
calculate?
From 918 or let's say this one from 1037 to 990. What is the change? How much is this change? From 1037.57 to 990. It is increasing or decreasing?
47.
The value is increasing or decreasing from 1037 to 990?
Decreasing.
Decreasing. So that decreased value is 47.56.
Okay, sir.
It is reducing by 47.56. Now we want to know by how much this should increase. And that increase is simply 2%. If it is increasing by 2%, it means this point is 12%.
Okay, sir.
Got it?
Yes,
Okay.
sir.
Fine. So with that, let's just stop here, guys. See you tomorrow with more interesting stuff about the cost of capital. Okay. Chalo. Bye-bye. Take care. Yes. Thank you.